Welcome to Mentor Club. Andy Tanner here, along with Noah Davidson. Noah, how's your morning going? Market's getting a little bit rocked.
Yeah, Mark, it's keeping me busy. It's been an interesting morning, but for all accounts, I am fantastic. Excited to be here.
So let's do the disclaimer. We're here to educate, not to advise, and that becomes ever more important when there's turmoil in the markets, because the short-term solution is, hey, give me a fish, tell me what to do. I need to eat today. I'm nervous. But that's not what we do. We train and we don't change what we do, whether it's coronavirus or a war or Fed bubbles or whatever presents. We just stay consistent in what we do, and we feel strongly that the four pillars of investing can guide an investor through any environment, or at least aid them in how they address risk that is ever present, but certainly more in times of uncertainty. We're going to do some illustrations as always. So we just ask, don't let these slip into the recommendation realm. And we don't give implied or express warranties on the trades we make working out just because they're educational, but more importantly, because I'm wrong so much. I've just learned that. And anyone who does this with any appreciable consistency or amount is going to find losses, and unexpected things. So that's just the reality of it, and we don't try to minimize that. And as a matter of fact, we try to walk in with our eyes wide open and say, well, if that's the reality, how do you deal with that? So all investing and trading in securities involves taking risk, and those decisions are for grown-ups and people that have a good team. So with that, let's get to looking where the market is, and let's see if we can learn some things.
All right.
Great. You want it?
It's pretty red today from a heat map
Yeah.
perspective. I've got Invis open, just kind of going through my
Yeah.
typical morning
Futures were
routine.
actually up a hair for a while pre-market, and then
Yeah,
everything just took a dive. And it's funny. CNBC will always try to explain why, and does it really matter? Like,
yeah. I mean, the headlines seem to try to. They are kind of hindsight giving a reason for why the market went up or down. Sometimes that answer is just, oh, there's more buyers than there are sellers, or there's more sellers than there are buyers.
yeah, yeah.
So
I would say that the big thing really is energy.
yeah,
We
it's
have uh,
been
we have. Whoops, didn't mean to throw in the scaring me energy. I went to get a Kleenex and I have these little buttons that, like, put out the little
little
sounds.
sound bites.
Yeah, I guess. So anyway, yeah, that did kind of work out. Energy, bum 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 bum. Scary music on energy. But yeah, the reality is, it's funny how political this gets, is because from my home country, the U.S., the one political party says, "See, we should have expanded our green energy efforts to become energy independent." The other party says, "See, we should have drilled more." And both are right, probably. I mean, bottom line is energy is the issue.
Yeah.
Um, so that that's just the reality of where it is. So as the threats to say, hey, Russia, we're not going to buy energy from you, meaning natural gas and oil. The price of oil goes up, and oil makes the world go round, man. It's not solar yet. It's not wind. It's not hydro. Hydro's kind of rough because you can only build so many damn dams, and the world runs on oil, and so Russia's got kind of an interesting situation. They're doing everything they can, but we know the real artery, if you want to really put a tourniquet on Vladimir Putin, it's going to be through the oil. And I think the markets were hopeful that the other sanctions might do something, but he looks pretty bound and determined. And So, there's a difference between hurting someone and knocking them out of the ring, so to speak. You can go in and throw a few jabs in someone's forehead, but if you want that uppercut to really knock them out, for you could probably do that if you quit financing them with their energy export. I guess I'm not a political analyst, but that's why we're seeing the red is oil
Yeah.
affecting everything because everyone needs it. And if you have a business where you're going to put something on a truck or a train or a plane or a ship, there's going to be fuel to deliver it, make it, bring in the raw material, whatever. And that's why oil makes the world go round. You commerce flows, manufacturing flows on the back of oil. So you see
Yeah.
oil
And
go up, and that means corporate profits go down. And I would imagine it means a couple of things. It means less people buying stuff because they pass those expenses on to the consumer, which raises prices, which means people buy less stuff, which means the corporate profits do suffer. So anyway, that's my theory. I don't know. What do you think?
well, I think at a certain point, as supply demand shifts, some corporations will really profit handsomely because the expenses and things like just there's a supply demand, and profits are always the highest when they can get a little bit of a premium out of the price. But then over time, I think they'll suffer, and oil and gas companies will probably do extremely well,
Saudi.
depending on their cost of extraction and refinement,
Yeah.
and aerospace and defense is popping. So I mean, yeah, I mean it's definitely understanding the price of oil really helps understanding global commerce. I mean, it really does affect everything. It's the mother of all commodities. But we're also seeing precious metals spike, the dollar spiked actually. So quite a bit. So right now, my general thesis is, markets caution, bearish, energy and aerospace and defense are hot. Transportation's popping, and then surprisingly, healthcare is actually showing some life. You've got some bullish sick patterns and whatnot across healthcare. But when I look at headlines, there's a lot more of the pundits out there talking about global recession, bearish indicators, rough road ahead. The market itself selling off a bit, and it's hard to say. I don't know that I can really predict the future because right now I can see some bearish opportunities, but I also kind of excited for the long term investment opportunities. Like bear markets will spook the average person out there, and they'll scare off a lot of the Johnny come latelys who are just trying to get into the action and trying to get rich quick.
Yeah. Yeah.
But it creates opportunities. I mean, a bear market creates short-term trading opportunities, but it also creates the best long-term investment opportunities. And so I think it's an exciting time. And we're kind of watching history unfold and watching the markets play out. I put a little additional hedge on, so I now have 3 contracts hedging everything. As it broke down below these candles, it kind of ticked that off overnight, and then it rallied a bit, and then we're seeing some continued selling pressure. So we now have 3 contracts hedging the portfolio here. Let me pop that open. And we got some long oil contracts. We now have 3 ES contracts hedging the portfolio, so that's taking care of some of our downside risk, and those are performing extremely well. And then price of oil is popped.
Yeah, we can't, we shouldn't gloss over that because that's real. I mean, you look at those numbers, that's pretty key.
Yeah.
The idea of hedging and keeping things neutral to offset. And I think it's important that this is not seeking to be opportunistic as much as it's seeking to be defensive.
Correct. Just kind of go where in this case with the hedge, you are defending your portfolio, defending your positions, and it's usually short term. Usually what happens is the market takes these sharp turns down, but then it'll rally, and it'll rally really hard and fast. with these counter trend moves. So we need to kind of trail our stop losses down and see if we can lock in some of the positions. I've left 2 of the contracts on through this entire drop rally.
We should talk about whipsaw here, because I think
Yes.
that, if you're trying to learn how to do that, well, first of all, the Mentor Club is a immersion experience. So, we do our 4 pillars, and, we do all the courses that we teach, and then you watch us apply it here. And, delta hedging, I think one of the best courses we have is the delta hedging inside the Ultimate Options course. So if you haven't taken that, you might consider that time investment. It's a bigger time investment than it is a money investment, because it takes a long time to get through that course. But man, education is nice to have. But we should talk, that aside, we should talk a little bit about the idea of whipsaw, because I think that's the biggest challenge you get when you decide to hedge something, because when those things are so leveraged that if they take off, like you just mentioned, when you get in volatile times, you have swings to the downside, and you also have pretty big swings to the upside. And the whipsaw can really cost you some money if you get caught out of sync with it, I guess you'd say.
Oh yeah, I mean, and the full size, the slash ES contract, that might be overkill for a lot of portfolios out there. You have the MES is the micro mini futures, and that's got a little bit easier to manage leverage for typical portfolios.
Yeah.
But they are all leveraged, and so you can get enough protection, but there is risk involved with the hedge itself. And so you'll notice I have a stop loss out here. That stop loss is at the break-even point for 2 of the contracts, the cost average of the 2 contracts.
That's quite a distance. What's nice is when you can slide it down to the break.
Yeah.
But
well, and I just added a 3rd contract, so that's going to lower the cost base, because I sold this one for cheaper. So now I have to restructure the stop loss.
Yeah.
But yeah, no, it's definitely, you want to be able to move those down to break even when you can. So, as of right now, if we were to go look at our ES position, they take a moment to pop up. There it is. Our new cost base average with the 3rd contract's 4,375. So that's the new break-even point right there, 4,375. So if we were to, take this little price slice here, that's where it was, and so I just slid it down, and we set that on the chart. Set slices to chart. So that's the new break-even point. So I need to bring the trail stop down to just about the top of that candle, and I might give it a little buffer still. But that downward movement, those rallies are always so kind of violent. They just drop, it drops hard, and then it rallies just as hard. And if you wait too long to put on the hedge to the downside, you might just get caught on the whip side. You might just get caught on the backside. So we want to, when we go to hedge, I'm always hedging when it breaks a key support zone, or when you'll notice here, like this price average is below the 200 period moving average support zone. This 3rd one was when it took out these candles here. So now I've got a new cost average, and so we'll want to, for now, I'll slide this down here and make sure that we.
And I think it's important to remember that what we're trying to do is achieve neutrality.
Right.
Where if it does go up, what we're really doing is giving up some upside to protect against some downside. That's really important. Correct. Delta neutrality means that in my mind, if it falls, my net worth is fairly, is more stable, and if it rises, the net worth or net liquidation is fairly stable. And so, yeah, I might be losing money on the hedge as it rallies, but I'm also making money on the stocks and still enjoying my time decay and my cash flow.
Yeah.
And so setting them too tight by freaking out, like if you freak out by having a $10,000 loss, let's say, on your hedge, well, hopefully that means you made a $10,000 thereabouts gain in all your stuff.
Mm-hmm.
So setting those too tight is probably the biggest mistake. Is a person who have the stomach to be delta neutral and give up the upside as well as protect against the down. Any thoughts on?
Yeah, absolutely. I use 2 simple methods to help determine how loose to put the stop loss because you don't want it too tight. It'll just get hit. And so I use ATR as a gauge, and then I will set it behind like candlestick highs. And a candlestick high is usually an intraday resistance pivot. So if I were to, change time frames and go down and look at, what was that time frame I just had here? 15-minute. Let me back that out to 30 minutes. I got some indicators on there. You can see these little intraday swing highs like that. That's a pivot point. So we trail our stop loss down. We're behind a resistance point. And whether I'm trailing a candlestick high or an intraday pivot, candlestick's probably the easiest. Just stay on the daily chart and you trail your stop loss down. Like for example, check this out, Andy. I was gonna the price of oil's popping, right? And this is the trailing stop for the contract that I had down here below these last candles. And now that it's popped up, I want to drag that up and set it below the candle low. And so as it corrects, it'll help us lock in a gain, and you won't get, right now you'll see this big, beautiful gain. And if it comes down and hits your stop, you'll still win big, but you won't win as much as you saw in the account briefly. But it's to prevent that reversal because, if oil can pop up and go up and hit $130 a barrel real quick overnight, it'll probably come back down at some point as profit taking and, price correction. So they'll probably be in a little pullback in here, giving us an opportunity to buy again. But that's trailing the stop and using what the market defines as price highs and lows. I think it's one of the easier things to do is just trail behind a candlestick. You let the market define the price point and then you put your stop loss just beyond it.
Yeah.
So that's
I think that's a critical deal right there is the defense of the account. Really important stuff. Yeah.
Well, absolutely. And so, some people will trade futures just purely for speculation, and more power to them. It's a lot of leverage to wield. We're using a little over 2% of the account. Right now we're at about 3.5% of the account to hedge the whole portfolio. And it should never take you more than 5% of the account. That's one of the benefits of the leverage that you get.
Yeah.
So it depends on your account size. And again, the full size ES contract is for larger accounts. It's for, you've got to have a pretty good size account.
It's really your delta that you're looking at that beta weighted, you're looking at that cumulative delta column and find the instrument that works. If you wind up with a nice 50 delta that does it, great. But you might do a combination of 1, 2, 3, 4, 5 bigs, and then it's kind of like dollars and cents, right?
Right.
I don't know if that analogy makes sense, but you don't pay everything, and even you don't whip out $100 bills if it's $50, and you don't whip out a $50 bill if it's $35.
Right.
So you kind of have your big bills and your small bills until you get the exact amount you're going to pay. And I think the same way with the ES minis and the those mini.
Or even like using options on the spider. Like again, for smaller accounts, you'd probably use, like for a very modest account, you'd use the SPY.
Yeah. The reason I like futures better is because there's not a time decay element. That's what's nice about those. When you start using options,
no time decay, no volatility shifts. Like the VIX right now has popped up, and so right now buying put options as insurance is a little bit more expensive. If you take a look at the VIX, it's hitting 36 right now.
Yeah.
So put options are a little bit more expensive. Some downward pressure in the market. Buying puts as insurance would cost you a little bit more, whether it's on the individual stock or on the SPY. It'll cost you a bit more. So in that case, to help offset the cost, I would use like put debit spreads to hedge if I was using the SPY. And then, the MES is the same as the ES, like it's the exact same chart. The leverage is 1/10 of the size of the full size contract. So you can kind of customize it. So an account might need one full size contract and, like you were saying, dollars and change. and 2 mini contracts, or you might only need, 1 mini contract and an extra put option or something like that to help you manage the risk. And I don't know how big of a downside risk we have. I mean, the market's in correction mode, and I think there's some concern out there, but who
Yeah,
knows? I mean,
I'm concerned without a war. I
right.
mean, I think the Fed was in a heck of a mess before, and I think that's just been exacerbated. Um, I don't know what the Schiller is, but it's still got to be high 30s.
Oh, I would imagine it is.
So
Schiller PE. And we just kind of came through earnings season, so we got
that's
a
not,
little bit of it. Yeah, it's
yeah,
dipped down to 34,
yeah,
down
okay.
a touch,
So mid 30s.
but it's still
Uh,
high. I mean, that's
Still
still,
elevated. It's only been higher one other time, and that's when we had a lot of companies that weren't making any money.
yeah.
We were paying price for what they might do. Um, let's talk a little bit about. So we've talked about defense in terms of hedging, and that's an important conversation to have. How did we beta weight? How did we defend? The second thing is maintaining cash flow, and then the third thing, it makes sense to defend what you're doing now, maintain your cash flow, and then if we think opportunistically, what are the opportunities that is in the market, no matter what the circumstance is, up, down, or sideways, come what may. And I think you and I had an interesting conversation that we could share with everyone is, of the four pillars, you could think fundamentally right here and do really well. And you might also think technically right here. And it would be interesting because depending on the style of trading, I really enjoy buying stocks. I get probably too much of a dopamine hit when I even find a new company that I don't have a position in. I think, I'm going to take a position in this company now for, the foreseeable future, for a long, long time. So when you see us off our highs from, 48 to 41, maybe you get down to 38, I don't know. But I think I get excited about looking for opportunity. And I think you do that through fundamentals where you have some pretty good companies that are pretty well run that have just simply gone on sale because they've been part of the tide going out, so to speak, right? The tide's gone out, all the ships have dropped, and it's time to shop for things on sale. The other part of that is looking at things technically. What is poised to go on sale even more? So you have two ideas here that can be fun to look at. Is you have your speculation and your investment, and they're both fun to do. It's fun to invest and it's fun to speculate. It's important to keep the two in the Intelligent Investor by Benjamin Graham. It talks about the importance of keeping those ideas separate, and he says keep the accounts separate, keep your speculation account separate from your investment account. But I do think it's important to keep those separated when you're investing and you're speculating, because when you speculate, you're looking at price. When you're investing, you're looking at earnings and growth, and two different ideas. So let's speculate.
Well, yeah.
Let's look at
So
both.
technically versus fundamentally. So, and we can kind of do some of the same scans, Andy, to find stuff that's, you'd probably want to do a fundamental scan using fundamental criteria, but I could also just filter off of technicals and then try to cherry pick out the companies that strike me as the fundamental outliers.
Yeah.
So one of the simple things I'll do is I'll just come back and say, well, show me what sectors have been beat up, because that's where the discounts might be. And so I can say, well, over the last quarter, okay, some communication services, technology has been beat down, semiconductors have been beat up, software, industrials. There might be big opportunities in industrials. And so, or I could go look at it by these little groups. I can go click at groups, and then it ranks it by the sector groups, and you can kind of see who's been beat up the most. So over the last quarter, consumer cyclical, technology and communication services have been hit the hardest, and energy, basic materials, and utilities have done the best. So I can start with that kind of pre-filter over the last quarter, like year to date or whatever you want to look at. And really, it's been the first quarter of the year where from the market hitting those highs down to the correction. So that's probably good enough. And then I'll just go use the little screener. And the screener allows me to filter for both fundamentals or technicals. And FinViz is a free screener. If you don't subscribe to it, you get a lot of pop-up ads. But I do subscribe to it just so I don't have to have pop-up ads, and I get a little bit expanded capability. I like to filter off of, show me the stuff I like to have all options on the table so I can do everything. I like to stick with stocks that are on the more like over like $50 or over whatever price threshold you're comfortable with. If you have the pro level, you can actually set like a price range. So I can come in and I could actually go in and set a custom and pick stocks by price. But I'll just stick with over 50 for now. And then you could go pick, your like technical criteria, fundamental criteria. I like to get average volume. Give me the stuff that's really liquid, that's averaging over 1 million shares at a minimum, maybe more. And then from here, I either go to fundamentals and search for fundamentals, or I go to technicals and I search for technicals. And so I'll start with the technicals, and I could just say, well, show me the stuff that's on sale. Show me the stuff that's down below its price, below its 20 period simple moving average. Show me stocks that are below their 50 period moving average. Show me the stocks that are down below the 200. And these will be stocks. Now we've got a list of about 342 stocks that have been kind of beat up or that are in a downtrend. I could look for a trade signal, like show me the stuff that's trading right at support resistance lines. And now I've got 5 companies. There are 5 things that I can look at. And if you look at these charts, these should all be in downtrends trading near support, or, here you go. So USB, it's just knocking on support. If that support were to violate, that could be a trade opportunity. I'm not very familiar with Sensata Technologies, but same thing. It's just knocking on support, knocking on support. If that were to violate, that'd be a trade opportunity. Dow Jones Industrial Average looks like it's breaking down. Owens Corning just broke, so that might be one I go look at, and I could say, okay, well, this was right here knocking on support, and it just broke. And from a trade perspective, OC, it's breaking support. It's got good momentum to the downside at the moment. I could do a short sell on stock with a trailing stop and have a simple trade. And so, I mean, that's thinking from a technical short-term trader perspective. I'd want to make sure that the stock was easy to borrow. Short selling I find interesting, is a lot of people don't understand the mechanics behind short selling.
People caught when you said easy to borrow, the fact your cursor was on top of easy to borrow, and that's what
it says ETP. Yeah,
it talks about. For example, GameStop for a while was impossible to borrow, and so you have to have shares available to be borrowed.
Yep. So you'd open up a position with the sell order, and I might do a trail stop, like a first trigger sequential. I'll create an opposite order, and I'll do a trailing stop on this, where I'll say, hey, this stock has about a $4.20 ATR.
Yeah.
And to avoid whipsaw, and if I'm doing 100 shares, that would give me, I could say, well, give me a $4.50 trail stop. And that would create about $450 risk to open up a position. But I think this stock can drop to 70. And if that was to be the case, I'll go ahead and send that in just to demonstrate. So there's the trail stop, and that'll chase it down. And if the stock were to drop down to 75 or down to 70, now we would have a position where 75 we'd make $700. If it got all the way down to 70, we'd make a little bit more. Oh, that didn't. Did I lose you?
No, just
Oh,
watching.
okay. I'm not sure what happened to the cursor there. It is not behaving quite nicely. Let's see if it'll. There we go. If it got down to 70. Oh, I got a. Okay. The software was about. We'd make about $1,200 if it were to drop that far. So I don't know how far it really drops. I mean, I'm just looking at the chart and saying, well, 75 is not that far away. 70 is a little further, but one of these swing ranges would cover about a 10, 15 point
Yeah,
drop. So
you often draw your little rectangle boxes to get a gauge of how far things move, and then extrapolate that, which isn't a perfect science.
yeah,
But
no, it's a ballpark. It's literally just a ballpark guess. It's just saying, well, it was, moving between 85 and 95. Well, that's a 10-point range. Well, if it broke
that's where we
support,
wind up.
it'd
Yeah.
get towards about 73. And that's assuming it ran clean and didn't have, any noise behind it. And that's just a short-term trading opportunity. I don't have any long-term perspectives or even a fundamental opinion of Owens Corning. Now, if I wanted to go sit and look at their fundamentals and look at it from the longer term perspective, that price going on sale could be a good thing for investors if they're interested in buying the stock at a discount.
The
You
very
change perspective from long term to, from short term to long term, and the people who will be buying it down there at those lower prices are probably investors.
which is the very term long and short has to do with the time you would be in it.
Yes.
Short term, well, you're borrowing, and you wouldn't want to be in a borrowing position in perpetuity. If I go to the bank and I borrow money, there'll be a term to that. It wouldn't be, well, unless you live in Japan, I guess it'd be multi-generational, but it's still a term. When we buy something, there's not a term. When we borrow something, there is. And the term is, shorter than forever. And so if you're going to borrow something and pay interest on it, you're thinking, hey, this is going to be to my benefit in the short term. It's not something I would stick to forever because I'm borrowing.
Right. Well, and that's important part of the equation. I understand that you did borrow the shares from the broker, but the broker doesn't own the shares. They just lent you shares that belong to somebody who holds the stock.
Yeah.
So they lent you somebody else's shares short term,
can-
and they charge you interest for the amount of time you have the position open, and they
Yeah.
amortize that daily. And so
Banks
there's a cost associated with it.
Banks take people's savings and loan it out to buy houses.
Yeah.
I mean, that's
Exactly.
the game.
Yeah.
And so
Exactly.
brokers just do the same. One of the things on FinViz that I like to do when I'm so there's your speculation on price movement. Now, what a person might do is let's look at that OC chart as well. Let's just go back to your OC chart. Let's go back to the one in Thinkorswim with your box on it.
Okay.
So what I'm thinking is so if I want to invest, I think about this different. I say, gee, what if this got to 70? Would that be an opportunity based on their fundamentals that would excite me? Would I be able to run some fundamental scans and say, is Owens Corning a company that I would be proud to own over the long term because of the earnings that it makes, the value it gives? And so I might say, well, I'm not going to short this. I'm going to buy it if it gets there.
Mm-hmm.
So this is where selling put options is kind of an exciting idea, because if it doesn't get there, I get paid anyway. Mm-hmm. If it moves up, I get paid. If it stays the same, I get paid. If it goes down a little, I get paid. I get paid no matter what. And all I have to do is find a comfort level of saying, well, maybe it goes below 70, 65, 62 with a huge drop. Well, I say to myself, you know what, that's okay. That's stock ownership. And the way I do this, if you go back to FinViz, one of the things I like to throw in when I use this particular screener is on the screener, there's also a place to say, I want a dividend. I want to see if there's a dividend of 4% or 3% or whatever.
Oh, yeah. Find the companies that pay. And that would be under the fundamental portion, I believe, here.
It's, I thought it was in the all.
Is it under descriptive all? Well, if you hit all, you'll see everything. All shows everything.
Whoop, if you go to descriptive, it's second column, third one down, I think.
So
Second one.
descriptive,
Sorry,
second
second
column, third
column,
one,
second one down.
dividend yield.
Now, what's interesting about that is you can set it for whatever you want. So I'll, high, low, whatever you want. But the reason I like that is, let's say if you have a company with a 5% dividend yield, I look at my son and I tell him this, I go, look at how long it takes your money to get your money back out of it. And so let's say the dividend yield didn't change. It was just they didn't raise the dividend. And so you bought it at a 5% dividend. That's 20 years and you get your money back. So by the time my son goes from 16 to 36, by the time he's a young man at 36, he's got his money back. If you're in your 40s, by the time you retire, you're going to own whatever you bought free and clear, and now you have a machine that just, cranks. And that's a nice feeling because then you're not worrying about stock price. But what's really cool about this is if I find it has a 3% dividend or 4% dividend, sometimes even a 5, whatever it is, then I go look at their options and I say, gee, I can conservatively write covered calls on this. And, can I get myself a 8, 9, 10% return? Now it's paid for itself in 10 years. And if they raise the dividend, which sometimes is the case, and this is really important, if the price goes up, the amount of premium the amount of premium I can collect on a $50 stock is twice what I'll collect on a $25 stock, if that makes sense. Yeah. So if over that 10-year period the price jumps, I'm writing premium against my original cost basis. And so the dividend can climb and the premium can climb. What we're hoping for is now we say, is there a possibility, not a guarantee, but there's a possibility it can pay for itself in 5 years. So you can go from a 20-year time horizon to a 10 to a 5, possibly, depending on if the stock moves in your favor, the dividends go up and you'll collect more premium. Or another way to put that is you could sell them further out of the money because you'd need less premium. Right. To achieve your goal of income. So cost basis is a big deal. Warren Buffett enjoys a cost basis of Coca-Cola. He got in essentially at $3.25 on most of his shares. And if you've got in at $3.25, today's price is now irrelevant. It's completely irrelevant what it is, because it's paid for itself 100 times over. You get a dividend, you have a box, you have a machine that's giving value to the world, and who cares what the price of it is? You paid $3. And I think people get so tied up in stock price that they forget about earnings growth, which is dividends. What are we really buying the stock for? Is to sell products and enjoy profits from the products we sell. So one of the things I'll throw on that search sometimes is, and it'll narrow it down quite a bit, is I'll say, hey, is there anything there? And sometimes I'll lower the price from 50 to 30 or whatever, to see if I can pick up some bargains. Because instead of shorting, like if you're going to short, you want room to fall. You wouldn't want $5 stocks in there. There's no more room to fall. But if you're going to look for bargains, I might say, if I find a good $30 stock, bam, off we go. That might be cool. So anyway.
Well, so I just thinking of that concept right there. I set it at 3% dividend, took off the support resistance. So now all we have are stocks that are over $50 that you can have options on, that average over 1 million shares per day, that pay a 3% dividend annually, and that are trading on sale below moving averages. That's a pretty basic filter, and that narrowed it down to about 29 candidates.
You could throw on some fundamental stuff and say, well, I want a PE of 15 or 16 or 20 or less.
Absolutely. So you could say,
Yes.
give me PEs. I mean, I'd start out with a liberal filter like under
Yeah.
30 and then kind of go from there. And so now we're down to 22. Okay, let's go PEs under 20. Well, we just narrowed it down to 17, and you
Maybe
probably recognize a
okay.
lot of these companies. Like, look at the names of these. You recognize these companies:
Oh,
Citigroup,
yeah.
Dow, Morgan Stanley, Philip Morris. I mean, there's
And
even an
it's
extra
funny
page here.
because you look at a company like Dow. I mean, I own like there's some here that I own Prudential, I own Dow, and I look at that and I think, wow, these are still good values even today. Um, even though I've owned some of these for a long, long time. So I think, wow, is this an opportunity to add to my Dow position if I want, or to add to my Prudential position if I want? Because the financial beats up, or do I say, there's 3M. That's kind of a deep discount off where it used to be. So anyway, this is kind of the investing side of it now. Is we're saying, gee, what if Dow got back down to its bottom there? Where it was on sale, right down to its bottom. Is that a bargain for me? What if that gets down below its support from last December? Do you want to buy some more of it, or or whatever? So let's
Well,
look at
yeah, no,
that.
I love the idea of like that. Dow 70-cent dividend on a $58 stock. I mean, that's a nice dividend.
It's pretty good
Um, I,
dividend. That's 78, or that's 78 cents times four.
and
Four.
we happen to have a couple hundred shares already, but it wouldn't hurt our feelings to say, you know what, I wouldn't mind buying a few more,
Yeah,
and
we're not.
at a price that we like, and we can get paid a little.
Yeah, so we look at that $52 area and we say, well, we might not get the premium we want, or we might buying it there. And we do this knowing that it could go further down, but we're saying, we feel we're getting a pretty good bargain, at 50 or 52, and you got to see if there's any premium in it. And you might say, no, there's not enough premium in it yet. Maybe I'll put this on a watch list. That's premium.
Well,
That's going to
yeah,
expire in 10 days.
that's a 10-day pre. You get 10,
11
for a
days.
55 for 11 days. You could pull.
Yeah.
Yeah, that's not too shabby. 55 out here, they're paying a lot of premium. 52.50, they've got decent premium down here. $50. I mean, you could get it for that's 74 days out in May.
Yeah. That's
Um,
the sweet spot I kind of like, is the 30-day.
yeah. So
Um,
to make a promise to buy it at 50% or $50, you could get
Cents out of that
probably
probably.
a 60-cent credit. That's not too shabby.
So what I like about this is I'm maintaining cash flow by doing something I'd like to do anyway. I'm hoping the market will drop a bit and I can pick up some more shares. And what's interesting is once you do this, you're gaining more power. A lot of people are trying to get out of the rat race, and part of this is the discipline to budget part of what your active income and convert that money into passive income. So if you still have a job, like I tell my son, I says, look, take the money you earn by whatever you do actively and just set aside some of it to, buy stuff so you can get some passive income. So you always have money allocated. I understand that, I don't want to, I don't want to be mean about this. I want to make sure I'm benevolent, because I live I live comfortably. There's a little bit of sadness, and gratitude when you look at like what the people in Ukraine going through. They don't, they're walking across the border pulling with what they can carry. And it just gives you a perspective on what the human experience is about. But if you live in a country that's democracy, there's always a choice about standard of living and wants versus needs and all that stuff. So I just encourage people to have a little money ready for when things go on sale. So when opportunity is there, you're prepared. and you can invest, because this is going to cost us $5,000 to keep this promise, right?
Mhm. Yeah. So, $5,000. Well, in a margin account, 2,500, and they start out holding just
Yeah,
10%.
exactly.
So, if we end up not owning the stock, it's a nice rate of return if we end up owning the stock. And if you're doing it in an IRA or retirement, which is probably, the smartest place to do this type of stuff is in the retirement account for the long term. If you can get it into like a, IRA or a Roth IRA or whatever the
Roth
equivalent
is
is in your
tax free.
country. Yeah, that's the smart way to go.
So
Using
we're,
margin can give you leverage, but at the same point in time, you pay interest on that money you borrow.
yeah, and here's the thing. Someone's going to say, well, Andy, $60, what is $60 going to do to help me, right? I mean, this is $60 off of 5,000. Well, yeah, but if you sell out of the money calls at this, and this is, what's the delta on this?
Oh, the delta's got to be about 15 or so. Let's see. Delta's 12.
Okay, so this is not something that I could, I'm selling the puts. Well, if I flip over to the call side and I find deltas of, 18, between 9 and 18, there's similar returns to be had over on the other side. Now, the VIX is high, so these may not last, but that's that's 1%, right? That's 1% basically. So if you're doing $60, let's say, and you won't get it every month, but that's $720 a year, right?
Mm-hmm.
And over 10 years, that's $7,200. So your payment schedule is way ahead of that 10 years.
Oh yeah.
And then what's the dividend?
70 cents a quarter or something like that. So that's handsome.
So 0.70 times 4 quarters, that's another $280, correct?
Yeah. So I mean, okay. So I sell that put. We pull in $60, and I go sell the $65 call with a delta of 18, and I have 200 shares. So I could sell 2 of those.
This is what Noah's doing here. If people want to know, is the majority of what I do. Now I'm still not above doing a nice broken wing butterfly or iron condors and all the cool stuff we do, but basically I have a lot of short strangles that surround stocks. So when I uncheck my stock box like you have, I have a lot of this stuff to where I say, hey, if it gets down to $50, I'll buy some more of this. I like the stock. I'd like to have more.
Yeah.
And I'm only going to wind up doing that maybe 10% of the time.
Mm-hmm.
So maybe once a year, I might buy another 100 shares or another 1,000 shares or however many I want to buy. Once a year, I might have to buy some more, but it's something I want to do because I'm buying dips. It's got to go, pretty far down outside of that standard deviation for me to have to buy it, but I'm double dipping. So if you were to look at this, and this is aggressive and risky and has to be managed, but think about this. If you're getting, let's just say $1.20 right here, right? Because that's really what you're getting. You're going to try to get 60 cents on both sides. Round that down to $1, right? Well, if you're getting $100 a month times 12 months, that's $1,200 a year, right? And then if you add that dividend, that's another $280 a year, right? So that's what, $1,400. You times that by 5 years and you got $7,000. You're free. So the options by double dipping with options and by adding a good solid dividend in, the potential, not the ability, the potential to pay these off very, very early. We go from a 20-year timeline to get it back from an aggressive 5% dividend down to, the options just help. Selling the premium just helps. Now, this isn't consistent because there's going to be times where you've got to have some money on the sideline. Like what happens if it goes up to 65, you don't want to get called out of your stock? Well, you hedge it. And generally what I'll do is I'll hedge it with stock. I'll have enough there to buy some stock. And you have to arrange your fares to where you're just called out at the price. You're basically you're gonna get called out at the same price you bought all that at, and it keeps your original shares intact. So anyway, interesting stuff, yeah.
Well, it's just two different perspectives. It's the short-term perspective versus that long-term perspective. I think the long-term perspective is wise and prudent, and it's takes patience and the right temperament.
It takes a tremendous amount of temperament and patience. And that's, if you look at it, I mean, that's a fairly aggressive trade. You're being aggressive.
Mm-hmm.
But I when I play basketball, I'm aggressive. I coach aggressively. Being aggressive is not necessarily a bad thing as long as you can handle being aggressive. So.
Well, it comes down to developing those rudimentary skills. Like, you can be aggressive if you know how to hedge, if you know how to roll the options up, if you've developed the skill set, you can know when to take those slightly more aggressive postures.
So we can go ahead and I like the idea of selling those.
Yeah, like I think in this case, let me create the order. I think I can pull 60 cents out of those. See if we can get filled on that.
We'll see. I think your chances of getting filled are pretty darn good.
Yeah, so probably, and if you put that together in that perspective, that's $180 cash flow on one extra put, a promise to buy an extra 100 shares, and it just covered calls on the 200 shares you already own. And
pretty cool.
For 38 days, that'll buy almost a bag of groceries, I think, maybe two.
Depending on what you eat.
Yeah. But no, cool. It's really interesting. Just the two, and there are opportunities regardless of the market conditions. There's opportunities. It comes down to mindset and perspective.
Yeah. Now, if you go back to OC, Owens Corning, if you really want to be aggressive, you could do both. You could say, well, that's fallen as we've spoken. That's gone down since we've spoken. But you could say, I'm going to short this, and I'm going to promise to buy some if it gets that. Then any money that you made on your short goes towards your cost basis when you actually buy it at the bottom. If you liked it fundamentally, you'd have to do this when you liked it fundamentally. Now, generally, you wouldn't want to short stocks that have strong fundamentals. So double dipping is kind of, yes, maybe no. You'd really be banking on the technical and the broad market for the dip more than your fundamentals. Because ideally, you'd also want, if you really want to just speculate, find something weak that's going to get weaker, and you'd find fundamentals that suck.
Well, they pay a dividend and they have a really low PE ratio, and it's probably a pretty fundamentally sound company.
Owens Corning makes a lot of stuff, and they're probably not going to go out of business.
Right. So I think the short-term speculation is aggressive, and it is just that short term, and so that's where, again, the name short, the idea of short still comes from. I like the idea of picking it up cheaper too. So
it would be interesting to add some bearish fundamentals on that scan and see what come up.
Oh yeah, you can come back, and that's the thing. You can sit and play with the scans. You can come back and I like the idea of scanning for strength and fundamentals, but you could also flip that over and say, well, show me the stuff that's overvalued. Like hey, if it's got a PE over 50 and it's in a downtrend, okay, Realty Income Corporation that shows up, or I can say, oh, PE over 30 or whatever. We can probably get, there's just one hit. So there's your theoretically fundamentally overvalued bear signal. Still
fun stuff to look at.
It is.
Pattern scans, you can do fundamental stuff, technical stuff, both. And if you've forgotten how to do this, go back to your 4 pillars course, because in both we show demonstrations of some basic fundamental criteria that we like on both of these. I believe we show FinViz and Yahoo. Mm-hmm. And one of the stocks I kind of caught my eye is I ran one for like, I think it was $30 or less, or $30 or more, and IP came up on both scans. I ran it on two different engines for different criteria, and I saw, man, this thing has lost a ton of momentum. I mean, a ton. And you look at how high it's been and how low it's been. And, what I love about a company like this is it's so boring. It's like, it's not, I mean, what they make is they make boxes. And I think about all the Amazon stuff, and I don't know what their reach is on cardboard, but I just think of all the shipping that goes on. There you got filled on your Dow, all the shipping that goes on. And this is something I don't own, but I think to myself, all right, what if it got down to, whatever, pays a dividend, and I wonder, how cheap I might be able to pick some of this up and build a position in another company. I don't know. Because I was looking.
There's your 4% annual. That's a decent little annual dividend.
I mean, it's not like if you're getting 4% off the dividend out of the gate, and that's if you bought it today. I'm talking, what if I buy it even cheaper? And I'd say I'm going to sell some puts on this, right? Mm-hmm. So I go down to a delta of 22, or maybe even a delta of 40. If I really want to own it, at the money, if I'm getting paid another $1.40, my cost basis now is, $38.60. If I'm getting paid $1.50, it's $38.50. Right here, I can get it, pick up some premium, get it for under 37. So, it's just interesting to see. I haven't bought it yet, but I look at a 4% dividend like that, and their PE. Check out what their PE is.
$9.7.
Pretty cheap stock. I'm paying $9 for every dollar earnings. I looked at the financial statement, and what they've been doing is reducing debt. So they don't have quite the revenues that they had before, and they don't have quite the network. They haven't had growth in the revenues and their valuation in stockholder equity has gone down a bit. But I've also seen that they're getting leaner. Their strategy has been to sell off some stuff. When I looked at their their statement of cash flow, their operational cash flow went down a little bit, but their investment cash flow, they sold some stuff off. They didn't finance a lot. They reduced their debt. And so it looks like this company's trying to get leaner and tighter and more focused. So I look at the broad, and it's been volatile. I mean, this thing's been all over the place. Go back to that weekly perspective. And, this thing, that's probably coronavirus. Yeah.
Yeah.
I mean, right now it's back pretty darn low, considering, pre-coronavirus. I don't know. I'm not.
I think that's an interesting candidate. I like the idea. As already kind of
case for it, other than I'm trying to make a case for it. Just that as I was looking at what I have, I was like, wow, gee, I got so much freaking finance, I got so much energy, and I got so much healthcare, and I got so much, and you're just looking to balance and find industries that I think, all right, we're still going to be using cardboard. Are we still going to put things in cardboard and ship them when I'm, 75 years old? Probably still are. Maybe there'll be a new technology come out that's better than the cardboard box, but maybe not, right? So anyway, that's one I had my eye on.
I think that's interesting. It's a very interesting perspective. So
what's more important is the idea of trying to bargain hunt, right? What am I finding that's fundamentally strong, that pays a solid dividend, that's had a good dividend history, that has a good what we call pay ratio. In other words, they have room to continue to pay it. Um, interesting stuff.
Well, and the strong fundamental dividend payers fare better in a bear market anyway because people tend not to sell them in panics because the people who are buying the fundamentally strong
I'm not selling my
candidate,
stuff.
yeah,
Yeah.
so they doesn't mean they won't go down. They'll go down. But the average long-term investor that has that temperament is gonna sell covered calls, maybe buy a protective put on it to cover the asset.
Yeah, and
Um,
maybe I don't buy this, but maybe I put it in my watch list to say, boy, if we have a landslide and we have a war, it's on your watch list. If this thing,
mhm.
if we have another problem and you can pick a company up like this at 25 at its low of 26.38 down there, wouldn't that have been awesome?
Yep.
I mean, what's the dividend? Those guys that bought it there in the 20s, what's their dividend
They're
yield?
getting this 46-cent dividend right now. It's been as high as 50. So they've cut their dividend a bit, but it
A
was
little
50
bit.
cents, 51 cents for a bit.
Yeah. So it's pretty interesting. You never know. There's risk involved. There's a lot of people that don't like this, by the way. I read some analyst reports. A lot of reason it's down is it got downgraded, right? People, oh, they don't think so. Well, I'm thinking, it's kind of like Warren Buffett. Um, he loves boring stuff that just, is going to be around. And I mean, the guy owns an underwear company, tidy whities. He sells underwear. No. Is it exciting? No. But do people buy underwear? Yeah, they do. And when they buy it on the internet and it's shipped to you in a cardboard box that gets thrown away or recycled. So you got to keep buying them.
Yep.
So anyway, that's kind
Sure.
of the
Well, that's
talk.
that's an interesting one because my least favorite chore every week, Andy, is breaking down the cardboard boxes that got delivered that week
Whatever.
and getting them into the recycle bin. It's just
It, that's, yeah, got your razor knife out.
yeah, breaking down the boxes. It's constant. It's constant boxes. That's an interesting. It's an interesting, boring play.
Oh, it's
It
boring.
is.
It's so boring. Should we go look at our monitor page, kind of look at our overview of everything? And
Yeah. So I mean, overall, we're very focused on theta right now. We have a lot of neutral positions that are cranking in the time decay for us. We've got just some legacy positions that have been locked down, like risk managed on them.
mhm.
And so, we got a lot of positions cooking, but some of these positions they're just tiny little positions, like $1,000 positions that are cash flowing. And so, credit spreads, condors, that's the delta neutral stuff that we've been doing.
Mhm.
We've got some stocks that are collared and some other positions that need to be managed. But overall, and I'm not sure we can. Let me see if I can switch it to the old layout here.
That's the thing I don't like about the new layout, man, is the old layout just kind of showed you what was up.
Yeah, we've got theta cranking at 302. Our delta looks abnormally large because I have long positions in oil and in silver, and I didn't get filled. I tried to do an option position on gold, and I just didn't get filled on it, and it ran
Let's
up.
look
And
at gold.
yep, so
I'm I'm bummed because I buy my gold for a hedge instead of opportunistically.
yes.
And when I see that, I think, man, should I sell it? Because that's
I
pretty
hold it.
cool.
Yeah. So that again, future. So I tried to do a option strategy on gold and didn't get because that there are options on the futures, and I tried to get filled on. I tried to create a butterfly, a broken wing butterfly on it, just didn't get filled.
Yeah,
But gold popped. It would have been a nice gain had we got filled. I just bought some silver futures contracts, and silver's up and we've got a decent little profit on our little silver trade. It's only popped up a little bit, but we're up almost $1,000 on it. And then we did the oil trade, which is pop, and the dollar's up, Andy. Dollar. This is the ETF for the dollar, and the dollar's popped. Bitcoin back on sale. Whoops.
yeah,
So
Bitcoin back on sale. I don't have any, we didn't, you know what? We should probably look at Bitcoin, shouldn't we? Because I
Yeah.
don't have any positions on my Bitcoin right now. And we could probably sell something. Let's see what that is. Let me get the, where's the thingy that lets me be the
I
guy?
think I need to make you the, yeah, there you go.
All right. You liking what you see here? So we're
There we go.
back
I see it.
quite a bit. We're down overall since we started, about $6,000. You know, just about right here, just below 50,000. Started with 56. We're down about 6,000, which is absolutely astoundingly amazing because we bought this at 55. Can you believe
Yeah.
that? And we bought these at 35, most of them, 3 or 35. So we're up to, if you look at what we have here, we have 4 Ethereum now. So we added another Ethereum off the profits that we've made. So that's pretty cool to be sitting there with 4 assets instead of 1 cash asset. And yeah, we're down about $5,000-$6,000 here, about 6,000. But I think, my gosh, having bought that at 55, I don't even know, I can't even do the math in my head. Let's call that 39. 55 minus 39, we're down $16,000. But we're only down 6. And then in these, if you look at these, we're down 1,000 times 4. So really, we're down $20,000 from the prices that we bought stuff at, but because the premiums we brought in, our account's only down 6. Dude, that's an amazing, like, that's pretty cool. I mean, how many Bitcoin guys that bought at 55 wish that you had to sell options on stuff?
And that they had
So
some Ethereum paid for.
yeah, so what that means is we'll maybe look at selling some. So these are March 11th. These are too short term for me and my taste. 40. I kind of like the 45,000, don't you? For $500, that's a pretty wide spread. What do you think? You like that?
Well, that's been a price threshold out there. Every time it's gotten up towards 45, they've been selling. So that is a resistance ceiling.
If we look at the recent trades, people have been trying to get 529, 6, 520, 520, 529. Let's look at the order book. Pretty wide spread right here. 44, 644. What's the difference between those two? 544, I guess, huh? Is right in the middle. Problem is not a lot of liquidity here. At least, you know, maybe some people would hop in, but there's not a lot of liquidity here. So if we do 100 contracts and let's just do 540, that's going to put us in the, you know, in the running here. I hate these wide spreads. I've said this since the day we started doing this, is I hate the illiquidity of it. And I hate the wide spread, and yet we're doing pretty well, man. You know what? We're doing pretty well. So let's try and sell those short and see what happens. So there we are. We're now asking 540. We're the new ask now. And we'll see if someone bites on that during the day. You know, I'll tell you this, I haven't had too many that I haven't been filled on if I just sat there and let it sit for a while and let it brew. So that's it. The Ethereum are all locked up, I believe. Yep. So the Ethereum stuff, we've got these sold here, these calls sold, and they'll expire here in about 2 weeks, I'd say. Is that right? And on this one, we brought in $110. On that one, we brought in 240. So 240 plus 110 is 300 whatever. And that's pretty cool cash flow, because what's 240 plus 110? 350?
240 plus 100. Yeah, that sounds about right.
So go out and get a rental house that get a little tiny rental house that cashes 350 and see what you can spend on that. Because you've got 4 Ethereum doing that, and that's about 10 grand worth of Ethereum. So I don't know what the ROI is on that. $350 divided by 10,000 bucks in Ethereum is 3% in a month. Times 12 that's ridiculous. And it's just stupid. That's just, and what that tells you there is that actually isn't awesome, because it's so volatile and you have to take so much risk to get it. So while I say, show me a rental house that can do that, someone might just easily say, yeah, but probably a lot safer investment to, I don't understand the Bitcoin people, because you know who a lot of them are? Gold people and real estate people. And you know what they used to tell me, all the gold and real estate people? Well, I like gold and real estate because you can see, touch, and feel it. And then all of a sudden Bitcoin comes out and they're all over it. I'm like, well, how do you see, touch, and feel that? They go, well, you can't see, touch, and feel stocks. I'm like, you can't? Look at your desk. Because if you have an Apple computer, you just saw, touched, and felt what that company does. It's real. You know, their technology's real, their IP's real, their products are real, their customer base is real, their headquarters are real, their factories are real, their employees are real. You know, Steve Jobs was real. It just kills me. So is it Bitcoin real? It's real because we think it is.
Yeah.
It's real because we think it is. So anyway.
There you go. Well, this is a fun Mentor Club. I've enjoyed this one thoroughly.
Yeah, kind of nice. It'll be interesting to see if we get filled on this order right here. We'll see if they do. So there you go. All right, man.
Awesome.
Should we end on that?
Well, that's probably a good place to end. Just remember there's short-term perspectives and long-term perspectives, and when the market's in that panic, there's room for both, but you want to keep those accounts separate. You want to keep your methods very, very sound on both. Like there's risk involved. You can make money on a bear market, short selling and speculating, but also what an awesome opportunity to look for value.
Yeah, and that opportunity could get better, And when you speak about long-term perspective or short-term perspective, I think about the people in Ukraine, the people in Poland, the people in Romania, the people in Russia. It's just a difficult time for so many human beings. How'd you like to be a Russian soldier right now? How'd you like to be that?
I would not. I would not. That would be rough.
I mean, you want to be. I mean, I picture myself in a tank, or the guy that is launching those rockets, and I wonder what that guy's mentality is, because he's doing. I think it is interesting how many military guys have come on the TV and talked about the will. Because once if you go in there thinking it's a peacekeeping mission, and you're thinking you're going to be liberating people, and all of a sudden you realize you're doing what is happening, it gets harder to push those buttons. And you just wonder, how many tanks are running out of gas because they're just running out of gas. Do you let it idle? Sorry, Commander, we're out of gas. Can't go do your orders. Got no gas. I don't think a lot of those guys want to be doing what they're doing. And when you're in a war that you don't want to fight, that your commander wants to fight, it's different than when you're in a war where you want to fight. So I'd hate to be any of those people. I'd hate to be on the offensive end or the defensive end. Poland's awesome, dude. You see those images? Talk about heartwarming. It's like, come on over. come on in. It's not like, I mean, I just picture, what if all of a sudden a bunch of people showed up to my house, said, yeah, we don't have a house anymore, so we're moving in with you. And you say, no, you're not. Go get your own house, blah, blah, blah. No, come on in. Come on in. We're here. We're here to help you. That's a pretty cool story.
It is. I saw one where they were leaving baby strollers at the train station for incoming mothers so that they would have.
Incredible. Absolutely incredible. Hey, speaking of that, maybe we should look at one more stock.
Yeah.
Talk about this. Let me give it back to you because you have your stuff set up better than I do. Here we're about to end, and people are like, I thought we were going to end. That's either good news or bad news for people. They're like, oh, cool, more stuff. Like, oh, gee, more listen, more work. It's all about an attitude. Market in Russia is interesting. RSX. So $5.
Yeah, it's down at 5.
So this is an interesting ETF. This could disappear. We've already seen some ETFs disappear already. We've seen some. Yep, we're done. We're done. Particularly those that are leveraged on this one. The one like I have the 1, 2, and 3 times leverage types of derivative.
Oh, yeah.
This one is an interesting. This is really an interesting deal. The VanEck, I think I'm saying that right. Is it VanEck or VanEck? I don't know how to say it. But I did a little research on this for those that care. And this is a private family-owned fund. And the VanEcks are U.S. So this is a U.S. deal that holds Russian assets. So they're a U.S. company that holds Russian assets. And what happens is in the 1950s, after World War, this is so interesting because really what it was post-war thinking is after the war was over in the 40s, there was investment to rebuild Europe, investment to rebuild Japan. There was an interest in gold because of Bretton Woods and things. And what these guys did is they said, hey, those that want to invest in this type of stuff internationally, we'll help you do that. And so they kind of made their mark as being a way that people in the United States could get exposure to the international stuff. Now, this is important to understand. One of the, you don't want to send any money to Vladimir Putin right now. Mm-hmm. So at least the way I look at it is you have Vladimir, who he doesn't need any money. He needs to kind of be, he needs to have an equal and opposing force to put him in check. But the people of Russia, that's a different story to me. I look at the sanctions as a necessary evil for Vladimir, but my heart goes out to the people that need bread there too, who, I just don't like the idea of saying the Russian. I hate it when they say the Russians are doing this and the Russians are doing that. I like saying Vladimir Putin's goon squads are doing this and that, because I think there's a lot. What, they have 15,000 people, I heard, out protesting that got in trouble.
Yeah. They had 3,000 arrests or something like that for protesters.
Yeah, ridiculous. So they're, I mean, you know how much courage that is? Anyway, I'm thinking past the war. I'm thinking, how long is this war going to last? What's going to happen? And would it be cool to have some, exposure to some of the Russian companies when they rebound, when the sanctions are off? Probably the most risky investment you'd make is to try to pick this up at $2. But your downside's limited. None of that money goes to Russia, by the way. It's kind of like the people that didn't understand it when they bought GameStop. They thought they were helping GameStop. And I suppose they helped their CEO because they helped those shareholders, I suppose, by propping it up. But you're not propping up Jack here. This thing's already dead.
Yeah.
But this is 30 companies. It's a little top heavy in energy. Commodities, it's got some telecommunications. It's just basically a basket of across several industries. Again, top heavy in materials and top heavy in energy. What's the premiums looking like on this? Because when the market opens in Russia, these could all be zero. I mean, they could all be dead. I don't know enough about the companies, but
We got some quotes, missing quotes, I think, at the moment. So I'd have to close my machine and open it back up probably to get. Anytime I see the
accurate
missing
stuff.
quotes, it's a matter of logging out, logging back in, and it takes 2
All that
seconds
stuff.
to do. But
But
there's
that
probably
also
some
is
premiums there.
probably getting more volatile and probably getting some pretty decent premium where the risk might be for a buck. And so if you have a vision of saying, look, someday this war will end. I don't see this like a 12-year Afghan, 10-year Afghan occupation. I just don't think that from what I've seen, the Ukrainian people aren't just going to they're just not going to have it. So yeah, go ahead, invade, take Kyiv, but keeping it, geez, you're going to have a hard time. How does Vladimir Putin afford to police still not giving it to us? And by the way, they might not be.
Well, at the full dollar strikes, they are.
They
So
might be trading the 50-cent ones. They might not be trading. So if you look at $2, if you can get 50 cents out of that, your risk is $1.50. Look at this. Let's say you get 15 cents out of the dollar. That's 15% you're going to make by risking $1. So you say, hey, I'll do imagine that, let's say you do 1,000 shares here. So you bring in $150 and you say, I'm going to gamble.
Cents.
What?
Ask for 20 cents, see if you can get filled.
Yeah, probably wouldn't get it, but now you're risking $800 or something like that, isn't it? Yeah,
well, you'd end up, you'd be having $800. So yeah, 1,000 shares of $1. That's 100. Yes, $1,000, and
yeah. So your risk is $800 now, and the worst thing that happens is you buy it at $1, and it opens up at zero. That'd be your risks, But what's interesting is, are you going to do it? If you're going to do it,
well, I'm asking for 20 cents. We'll see if we get filled.
Yeah. But now, if you go back and look at the chart, if you're buying this at $1 and it gets back up to the 30s, it's a $30,000 play.
Yeah.
Might take a few years. Might take a few years. And you'd have to hope all those companies survive and that the ETF survives. I mean, the ETF, if we were to Google it, so whether that's, I in a way it's humanitarian, it's a way it's unpatriotic. I don't know how I feel about that trade. I don't know how I feel about it. I mean, part of me, I'm so mad at Vladimir, but it's not like when what you're doing is you're just buying this from someone else who's bought it. So there's no money that goes to these companies.
Right.
I guess if they have insiders that hold the stock, it helps prop it up at $1. You're gonna get support at $1. That's not helping what do they call them? Oligarchs now? I had to learn what that meant. I'd look it up.
Oligarchs, yes.
Oligarchs. I don't know how they is it olig or
Oligarchs depends on your pronunciation. Yes,
that ain't helping them keep the yacht. If you say, if it falls another, if it falls from 35 to 1. Yeah, I'll give you your $1 for it. That's not helping them much. So anyway, but it does. It is an interesting trade. I'm fascinated to see if this opens up or goes out of business. I mean, this is a lottery ticket.
Yeah. They could end up delisting everything, and
it could be a train wreck, but it is 30 different. I think it's 30, if I remember right. I did a little research on it. My brain's so bad.
I've looked at the top 10 holdings on it, and I haven't really dug down much below that. But
but it's telecom. It's just a basket of Russian companies, and I don't know much about those companies. Maybe they're held by all corrupt people, and if so, then I'll get out. Get rid of it, or just lose all the money in it. So. We'll see. Imagine that. Selling puts to buy Russia for $1. You can buy them for $1. That's something.
That's
Stayed.
on sale. So
Didn't see that one coming a month ago.
it's been an interesting couple of weeks, that's for sure. So
there's your Bitcoin, there's your Russia, there's your hunting for stuff, there's your speculation, there's your cash flow, there's your hedge. Quite a minute club. A lot of stuff.
that it is. So S&P still trading down a little bit, so a little bit of downward momentum at the moment. We'll see if it's going to end up retesting these lows.
Looks like a downtrend to me.
Oh, it is. It's lower, high, lower. So I found these rallies to be a little suspect, and again, it's starting to establish more pattern, downtrend, like with the actual lower lows and lower highs, and violating all those averages. So we're getting into downtrend territory for sure.
Probably don't want to let the war overshadow the other problems in the market. I mean, this is an inverted head and shoulders, or at least with a cup and handle on the end of it. You had a big, where your limit is like the neck of a big head and shoulder almost. And then you got a little cup and handle. Yeah.
Kind of big head and shoulder there.
Then you got a little mini cup and handle in the last shoulder, kind of fins with a little bump, little cup and handle there at the end. Inverted.
Well, one I've used for years, Andy, is when both this is a weekly chart, and then you can actually kind of see the head and shoulders hiding behind the order there. But when the MACD, both lines cross below zero, that's been a strong
stuff.
So
shift your
it's a strong sell, and that's usually going to take about a 10% correction to cause
look
that.
How wimpy coronavirus looks now in the big picture. You can barely even see the global pandemic. You can barely see it anymore. It's like a little blip of history. It's not even it's not like this monumental, it's not what it was. The bears aren't what we thought they were. I'm going to send you the clip so you know what I'm talking about when I say the bears are who we thought they were. I'll send you the clip.
Okay.
Thanks much. Minute Club will see you next week.
All right. We'll see you.